Okay, so the last time we were together, we were going through sort of the steps. Um, Learning objectives 1 and learning objective 2 was really all about the analysis. Okay. Whereas you had to see whether an event was a transaction. If so, how did it affect the company financially, what two accounts were affected, and how they were affected more or less in the account. Then learning objective 2 said, okay, if there is more cash, what side of the account is affected, right? So you learned about the debit and credit side um, of that. So that was all learning objective 1 and 2 in about the analysis, and that's really a lot, right, to do. Learning objective 3, which we reviewed quickly the other day, is now that you've done all that analysis, you can actually start doing accounting. And the very, very first place accounting begins is entering the data into the journal. So the journal basically is the book that everything starts with in accounting. It's the very, very first place things are written down. And as you remember from the journal, things are chronological. So the date would be first, the account titles would be next, and then the debit and credit columns, which are covered here, would go. The first account listed is affected on the debit side. The second account that's listed is affected on the credit side. So learning objective 4, which we're going to be looking at today, tells you the story of what happens to the numbers after they go into the journal. And that's going to be where we get introduced to something called a general ledger, which is a very, very large book of accounts for a company. And it keeps information about what happened in each account. So in the ledger, there will be specific information on everything that happened in the cash account. Um, so every time there was a debit to cash listed in the journal, it gets posted, you learn this word, into the ledger on the debit side of cash. Every time there's a credit to cash, it'll get posted to the ledger on the credit side of cash here. And the same thing for all the accounts, right? The equipment account is listed here, but you'll see every single account that the company has is listed in the ledger. And the story of what happened in those accounts is basically summarized in the ledger. Okay. But everything from the ledger comes from the journal, as you're going to see. So this is where we're at in our process. So remember, we did a whole bunch of journal entries the other day, listing that we've done our analysis, right? And from the analysis, now it's time to actually journalize that analysis in the journal. So for every event that happens, you will see a journal entry. So, and we did this for the first few transactions for Sierra Corporation. This first part is all the analysis. This is the journal entry for that analysis, right? And this is what we covered in class the other day. Again, the analysis takes place first, then the journal entry for that analysis. So what happens to all these numbers that are listed in the journal is the story of objective 4, okay? So today we are going to focus on learning objective 4, which is what happens to the numbers after you enter them in the journal. Well, they go to, as you heard earlier, they go to something called the general ledger. Okay, so this is an important part. So the ledger is, and it used to be a huge book back in the day when we really didn't have any computerized records. Um, these were huge, huge books because the ledger showed everything that was happening in all of the company's accounts. And the ledger has a very specific organization to it. So imagine you're opening up a ledger back in the day. The very first things that are listed in the ledger are the asset accounts. And they're listed in the order you would see them on a classified balance sheet. So without surprise, the very first asset account you're going to see in the ledger is going to be cash. And everything that happened to cash is going to show up in the ledger, in the cash account. Where do those numbers come from? They come from the journal. So that we transfer the numbers from the journal into the ledger. And again, back in the day when we did this by hand, you could just imagine. Thankfully, we have tremendous computerized software systems that make this process significantly easier. But if you don't understand what's happening, you can't use the software. It doesn't mean anything to you. So that's why we have to teach you this. So again, all the asset accounts have their own separate section in the ledger. And so you will see assets listed in the ledger section by section. It's almost like opening up a book and turning to chapter 1. And chapter 1 is a separate section than chapter 2. Well, that's how a ledger is sort of fixed, right? You open it up and the very first section of it is everything that happened to cash, and only cash is listed first. Then the next section of it in this case would be everything that's happened to supplies in its own separate section. And then the next section would be, another asset account, et cetera, et cetera. When the asset accounts are done, the liability accounts are listed next in the ledger. And again, they are listed in the order you would see them on a classified balance sheet. Okay. And so notes payable would have its own section, and everything that happened and notes payable would be posted there, then accounts payable, et cetera. The third section of the ledger would show the stockholders' equity accounts that we are familiar with. Common stock would be first, retained earnings would be second. The ledger, however, puts the dividends account after retained earnings in the order of accounts that are listed. Okay, so you'll see that. Then the revenue accounts are going to be listed, and then all the expense accounts are going to be listed last. So in essence, the ledger has sort of this pecking order of accounts that when you open it up, this is how the accounts would be listed. Okay. A lot of people want to start a business, but one of the first things and why accountants are often one of the first consultants to businesses is in order to have a business and do accounting, you need to know what accounts your business needs. So the first thing you're doing is really creating what's called a chart of accounts for your business. And this is a sample chart of accounts for Sierra Corporation. Now, Sierra Corporation is a small, company that gives tours here, right? So they don't have a lot of asset accounts. They don't have a lot of liability accounts. They don't have a lot of accounts, period, right? But over time, the chart of accounts can grow as more things are happening, as the business expands and changes and gets more things. This chart of accounts will also grow with the business. But you need to have a chart of accounts, because if you don't know what accounts your company has, how the heck can you do accounting, right? Because accounting is all about the accounts, right? You have an event, it's a transaction. Okay, you think about what two accounts are affected, and it's like, well, I don't know what my accounts are. Well, then you can't do accounting, because accounting is all about these accounts. So this is really, really important to sort of understand. So this chart of accounts basically is also how the ledger is organized. So again, if you look at a ledger as a very large book, each of these would have its own separate section in the ledger in the order you would see here. Assets listed first. So the first section would be cash. After the cash ledger is done, you would see what's going on in accounts receivable. After that, you'd see supplies, et cetera. It's listed in this particular order. Okay. So this idea of what we're learning here is transferring the entry from the journal, the starting point where we're putting stuff in, to the ledger, right? And the ledger is organized by account. And so if you look at here, the journal for our very, very first transaction for Sierra Corporation, we debited cash $10,000 and we credited common stock $10,000. Okay. And so what happens to the numbers from then? Well, this $10,000 debit to cash is then posted to the general ledger in the cash account. So this is what we call posting. We are transferring that debit to cash in the journal into the cash account in the general ledger, showing that it has indeed been debited. When was it debited? October the 1st. How do we know that? Well, this is what that reference column is. The reference J1 means it's the journal page 1. The journal page 1. And so from the journal page 1, this $10,000 debit to cash occurred. So now we know. If you look at the journal, you'll see the reference number for the cash account is 101. That's simply the account number for cash on the company's books. And again, these are almost always filled in automatically. Actually, everything is filled in automatically when you set up that on your accounting software. But you won't really see these on your homework. But that's what that reference column is about. Okay. So again, posting is simply transferring the numbers from the journal into the specific account in the ledger. Okay. So not only would you do that debit to cash and post that in the cash account in the ledger, you'd have to also post that credit to common stock in the ledger as well, to its specific account, because it'll have its own thing. So basically, this is the whole process. This is a very good set of slides to look at really how far we've come in this chapter so far. We've done a lot of analysis. Look at the very first part of every event here, right? Starts off with the event. We have a basic analysis of what happened. Then we have the equation. And then we do our debit and credit analysis. All this analysis is learning objective 1 and 2 combined. Then learning objective 3 was putting it in the journal, right? That's the journal entry that you see here. This learning objective is about posting to each individual ledger account. So these are sort of like pages that are ripped out from the ledger. This is the cash page, and on the other side is the common stock page. They put them side by side in the slides because there's only so much room in a slide, right? So they just want to show you what happened. So as you saw, this $10,000 debit to cash that we saw in the journal is posted to the debit side of the cash account. So again, if it's listed on the debit side in the ledger, in the journal, it's going to be posted to the debit side in their ledger account. Common stock has a credit of 10,000 that's going to be posted to the credit side of the common stock account in the ledger. This process is what we call posting. This process is what learning objective 4 emphasizes. And they show you every single event. And look at the first 4 things here are all the analysis that we did in learning objective 1 and 2. Right? Is it a transaction? If so, what accounts are affected? How are they affected? And debit and credit analysis. Right? Then learning objective 3, we put it in the journal. This is the very, very first time accounting happens, is when we put it in the journal. So here we have a debit to cash of 5,000, a credit to notes payable for 5,000. Okay. So the next step is we need to transfer this debit to cash into the cash account. Now notice that it gives its second line. There's another line for each transaction. The first transaction isn't nullified by any other transaction. That still has to show up in the account because that actually happened. So each individual event that we record in the journal will be able to be shown in the ledger account. So this new event, this $5,000 debit to cash, is then listed right underneath the first event. Okay. Again, it's a debit to cash in the journal. It's going to be posted on the debit side of the cash account in the ledger. Note payable gets a credit here. And so notes payable account, which is liability, will show this being posted on the credit side of its account. Notice that the dates come along for the ride. And that's so we can identify when it happened. When we look at the journal and we look at the ledger, we can identify each transaction. Okay. So that's very important to sort of understand. And this is all we're doing. This is basically posting. Again, event number 3, lots of analysis that we did. All this was objective 1 and 2. Then we learned, okay, we can put it in the journal. Again, the very first place accounting happens is the journal. In this case, we had a debit to equipment for 5,000 and a credit to cash for 5,000. So again, that's the journal entry. We have to then post it in the individual ledger accounts. So this $5,000 debit to equipment is going to be posted in the equipment account in the ledger, $5,000 debit here. This $5,000 credit to cash needs to be posted on the credit side of the cash account. Okay. Now, this sets up a very interesting thing because the cash account is a very active account, no doubt about it. And one of the things you're going to be asked to do is tell us what the balance of an account is. So when you look at the cash account, you have 3 things that happened in the cash account so far. We had a debit of 10,000, a debit of 5,000, and a credit of 5,000. So the balance in the cash account would be, right, the bigger side. What is the balance on the bigger side? Well, there's 15,000 on the debit side. There's 5,000 on the credit side. The debit side is larger than the credit side by 10,000. And so the balance in the cash account would be a $10,000 debit balance. When we get asked the balance of an account, we have to tell not just the number, but the side where that number is. So in this case, the $10,000 is on the debit side. So we would say cash has a $10,000 debit balance. That's it. It's pretty simple. Here's the 4th event where we had someone give us a cash advance. We did analysis, lots of analysis here, and then we put it in the journal. The journal entry here would show a debit to cash of $1,200 and a credit to unearned service revenue of $1,200. Okay, so again, this is the journal entry. From the journal, it has to be posted into the specific accounts in the ledger. So this $1,200 debit has to be posted to the cash account. Again, it's posted on the debit side of the cash account, which increases the balance. The unearned service revenue is a liability account. So this credit to unearned service revenue is going to be posted on the credit side of the unearned service revenue account, which also is its balance. Liabilities have normal balances on their credit side. So if you were asked, what is the balance in unearned service revenue? Your answer would be, there's a $1,200 credit balance in unearned service revenue account. What if I asked what the balance is in the cash account is? Well, again, you would simply look at all of the debits as increases, all of the credits as decreases. You would see that the debit side is larger, right, by 11,200. So that would be it would be $11,200 debit balance in the cash account. Okay, because the debit side is larger than the credit side by $11,200. So the posting comes with one sort of extra thing to keep in mind is that you may get asked what the balance is in the account. Okay, and that's how we would do it. The 5th event occurred here where they got cash. Lots and lots of analysis went into it. That's our learning objectives 1 and 2 right here. Learning objective 3 was, okay, now that you have analyzed it, let's write it in the journal. And so the entry on the 3rd of October is a debit to cash, a credit to service revenue. The next step would be the numbers would be posted to the individual accounts in the ledger. So this $10,000 debit to cash would be posted on the debit side of the cash account. Okay. This $10,000 credit to service revenue would be posted on the credit side of the service revenue account. Okay. So now what's the balance in cash? Well, the balance in cash would be $21,200 debit balance because the debit side is larger than the credit side by $21,200. Okay. That's the balance. Event number 6, these are all important to study. Look at all the work you've done so far in this chapter. Look at all the analysis we did in objectives 1 and 2, which is why I spent the whole week on it. I think that's really where a lot of the work is here. If you understand the analysis, the rest of this is going to make sense. Then we put it into our journal, put in a journal entry in. So October the 3rd, we had a debit to rent expense. We had a credit to cash for $900. Again, what you have to do then is post it. So this $900 debit is going to be posted in the rent expense account. Remember, every account has its own separate record in the ledger. So when you look at the rent expense account, this debit is going to show up on this $900 is going to show up on the debit side of the rent expense account. When you look at cash, again, this is a $900 credit to cash, which means cash has been used, right? So that's going to shrink the balance in the cash account by $900. The 7th event here, lots of analysis that we did, right? By the time we were done with our analysis, we knew that we had more prepaid insurance, which is on the debit side, less cash on the credit side. That's what we put in our journal entry. Debit, prepaid insurance, 600, credit, cash, 600. That's how it looks in the journal. When we post it into the individual account, again, this $600 debit is going into the prepaid insurance account to show we have more of it. And this not $600 credit is going on the credit side of the cash account to show we have less of it. Event number 8, we purchased supplies on account. Lots and lots of analysis that we did here, showing more supplies and more accounts payable. The journal simply reflects that analysis by saying on the 5th of October, we have a debit of $2,500 to supplies and a credit to accounts payable of $2,500 as well. So that was our journal entry. This is, again, where accounting starts in the journal. Then we will post those to their individual accounts in the ledger. So supplies is an asset account, so that would be a little bit earlier in the ledger, and that debit would show up here on the 5th of October in the supplies account. This would be posted in accounts payable, a liability, on the credit side, showing we have more of this liability. Event number 9 is when we hired people, and when we hire people, we don't pay them up front, so not an event, no accounting. We paid a dividend later in the month. We did a lot of analysis on that. We know that dividends account would be debited, the cash account would be credited, right? So we simply wrote that down in a journal entry. Dividends got a $500 debit, cash with a $500 credit. That's the journal entry. We transfer them into the ledger. This debit to dividends would show up on the dividends account on the debit side. This credit to cash would show up on the credit side of the cash account, again, indicating we have less cash. And the very last event, we pay those employees. Now they cost us money. Now we do accounting. That's a salaries or wages expense. So our journal entry shows a debit to salaries or wages expense for $4,000, a credit to cash for $4,000, and then we posted it into the individual accounts, right? Salaries or wages expense debit goes here. This credit to cash will go here. Right? So one of the questions that we'll have, because this is all 11 events have been accounted for, is now that you've done all that posting, now you can tell us what the balance is in every account. Well, of course, for accounts like Supplies and salaries and wages expense, it's easy. It's a $4,000 debit balance. It's very easy. You're going to need to do much work on the cash account. And the cash account balance is going to be put on the debit side because the debit side is the normal balance of cash. It also shows we have a lot more debits than credits, and so the debit side will be bigger naturally. What the actual journal looks like is this. Everything that we just did shows up like this in the journal. The first few transactions are listed here. This is what a journal would look like. And the very last transactions are listed here. Okay. But the general ledger, again, each of these have their own separate section. So the cash account was very, very active throughout this month, and that's typical. The balance in the cash account is $15,200 debit balance because the debit side of the cash account is larger than the credit side by $15,200. So the $15,200 is a debit balance in cash. Cash, being an asset account, has a normal debit balance. Supplies is easy because we only had one entry, so that is also the balance. Same thing with prepaid insurance and equipment. All asset accounts, all of their balances are on the debit side of the account. However, when we get to the liabilities, the payables, right, these accounts have normal balances on their credit side. Same thing with unearned service revenue, which is also a liability. You will see their balances on the credit side. Common stock is a stockholders' equity account. Normally, normal balances are on the credit side. Dividends take away, right, from the profitability and the owners. That's why it's on the debit side. Service revenue is where the profits are. So that balance would be on the credit side. And then each of the individual expense accounts, salaries and wages expense, would have a debit balance. Rent expense would have a debit balance listed as well. So this is posting. This is posting. And it is basically, again, it's transferring numbers from the journal, which is this statement here, into their individual accounts in the ledger, which this is a very poor way of putting a ledger together, but it is what we've got. So how would it work? Well, here you would just simply read line to line. Here on July the 1st, we had a debit of $30,000 to cash. So, and again, you'll have to excuse my writing here on my computer, but on July the 1st, we would show a $30,000 debit to cash, and that's basically posting it to cash. Then common stock would have a $30,000 credit. So again, you want to make sure the date is in here, and that's supposed to be a 7. And again, the amount is on the proper side of the account, $30,000 credit balance. And that's basically what posting is. You're done with that one. Now you go on to this one. Accounts receivable. On the 9th, we'll have a $6,000 debit balance here. Service revenue, again, on the 9th, would have a $6,000 credit listed here. And so forth and so on. And of course, it doesn't give you the actual answers on this slide, but it does in the book. And on Wiley. So how did that go? Questions?